If you're over 65 and a homeowner, there are at least 5 forms sitting right within your reach right now. These forms can stop, reduce, or completely freeze your tax bill. 5 forms. But before we go any further, let's clear up one massive misconception, because it's the reason most qualified people never file a single one of these. Some people say this is only for low-income retirees. Comfortable homeowners who've paid off their mortgage think, "Not my problem," and move on. Others go the opposite direction. This is for wealthy people, and seniors living on Social Security tune out entirely. Both are wrong. Then there are the people thinking, "My mortgage is paid off. Taxes aren't really a big deal." They are. Absolutely, they are. The property tax bill on a home you already own outright is the single biggest recurring expense you'll ever face on that property. The county doesn't care that your loan is gone. The bill still comes. What if you're renting? Still relevant. The landlord pays that tax and passes every dollar straight to you through your rent, every single month. When that bill drops, your rent stops climbing the way it has been. So this list is for everyone. Whether your home is worth $90,000 in a small town or $400,000 after your county reassessed it last year, there's real money on this list with your name on it. Why does nobody talk about these forms? Because the county tax assessor's office runs on the taxes it collects. Every exemption they hand out is money cut from their own budget, so the county doesn't call you. They don't mail you a form on your 65th birthday. Your bank doesn't flag it on your statement. The realtor who sold you the house never brought it up. The average annual property tax bill is $4,800. For someone who's 65 and stays in their home another 20 years, that's nearly $100,000 walking out the door. And for a lot of you, most of that money never needed to leave. I'm going to walk you through all 5 forms one by one in plain English. Stay until the end, because the very last one is the quietest and most expensive mistake people make, and it's one of the easiest to fix. Form 1, the Homestead Exemption. This is the form most people assume they already have on file. They don't. Almost every state offers a homestead exemption on your primary residence. What it does is take a chunk of your home's assessed value off the books before the county calculates your bill. In Florida, that chunk is $50,000. In Texas, it's $100,000 on the school portion. Illinois, $6,000. Georgia, $2,000. Every state is different, but every state has real money attached. Here's where people get tripped up. In some states, the exemption is applied automatically when you buy the house. In most states, it isn't. You file a 1-page form with the county appraisal office, usually before April 30th of the year you want it to apply. File it once, and in many states it stays active for as long as you own the home. One piece of paper, one time, hundreds or thousands of dollars off your bill every single year. There's another reason this form matters. It's the gateway to everything else. The county won't let you claim the senior exemption, the freeze, the deferral, or the circuit breaker unless your homestead is already on file. Form 2, the age 65 senior exemption. This one sits right on top of the homestead. Most states that offer a homestead exemption also offer an additional exemption that kicks in the year you turn 65. And this is the form the county will almost never proactively send you. It's a separate piece of paper. You have to ask for it by name. In Texas, homeowners 65 and older get an additional $10,000 off the school portion on top of the $100,000 homestead. In Florida, the senior exemption can add another $50,000 on top of the basic $50,000, effectively doubling the total. In New York, it can knock up to 50% off the assessed value for qualifying seniors. A lot of people see the income limit and stop right there. New York's limit is around $58,000. Illinois is $65,000. They assume they don't qualify and never apply. But more than half the states with a senior exemption have no income test at all. Texas, Florida, Georgia, Tennessee. The exemption is age-based only. Income doesn't matter. Home value doesn't matter. You turn 65, you file the form, you get the exemption. Form 3, the Senior Assessment Freeze. This is the single most valuable form on the entire list. When you turn 65 and file the freeze application, the county locks in your home's assessed value at whatever it was the year you applied. From that point forward, no matter how much your neighborhood gentrifies, no matter how much your home appreciates, your tax bill is calculated on the frozen value, not the new one. Let me make this concrete. In Texas, once you file the over 65 tax ceiling application, your school district property tax is frozen at the dollar amount you paid the year you turned 65. Not the assessed value, the actual dollar amount of the bill. Your home value can triple. The bill cannot go up. You know who misses this the most? Comfortable retirees. Because the freeze is most valuable in exactly the kind of neighborhood a comfortable retiree lives in. If your home was worth $220,000 when you turned 65 and it's now worth $440,000 and you never filed the freeze, you're paying tax on every dollar of that appreciation, and you will keep paying on it for the rest of your life. The neighbor across the street who filed the form is still paying tax on the $220,000 number. Same house, same neighborhood, same year built, two completely different tax bills. The only difference is one of them filed one form. One rule you have to know: in most states there's a specific filing window, usually between January 1st and April 30th of the year you turn 65. Miss that window, and in some states you lose the freeze permanently. Even if you turned 65 3 years ago, in many states you can still file, but every year you wait is another year of overpayment you'll never get back. Form 4, the Circuit Breaker Property Tax Credit. This one is aimed squarely at homeowners on a modest or fixed income. The idea is simple. When your property tax bill climbs past a certain percentage of your income, somewhere between 3 and 6% depending on the state refunds you the difference. Most people have never heard the term in their life. Almost every state has a version of it. You file an application, usually as part of your state income tax return, even if you don't owe any state income tax. You report your household income. You report the property tax you paid that year. If the tax exceeds the threshold, the state cuts you a check or credits your taxes for the difference. Massachusetts, Maine, Vermont, New York, Michigan, Minnesota, Missouri, Maryland, Wisconsin, and Illinois all have circuit breakers for seniors. Amounts range from a few $100s to over $1,300 a year. The county will never tell you about it because the refund doesn't come from the county, it comes from the state. If you're living mostly on Social Security and a small pension, and your property tax bill is eating a meaningful chunk of your monthly income, you almost certainly qualify. The income limits in most states aren't low. Maryland's is close to $60,000. Form 5, Property Tax Deferral. This is the most quietly kept form of all. If you're a homeowner over a certain age, usually 62 or 65 depending on the state, and you've lived in your home long enough to meet the residency requirement, you can apply to defer your property tax payments entirely. That means you stop paying property tax, not lower, stop. The state pays the tax on your behalf, and the unpaid balance becomes a lien on your home, paid back only when you sell, refinance, or the home passes to your heirs. For a homeowner who is house rich and cash poor, which describes millions of seniors in this country, this is life-changing. You can stay in the home you raised your kids in for the rest of your life without writing a single check to the county. Oregon, California, Washington, Colorado, Texas, Tennessee, Idaho, Illinois, and Massachusetts all offer some version of this. In several states, the deferral is available regardless of income. The interest rate on the deferred amount is low, typically 2 to 6% simple interest. One important rule: if you have a mortgage, check with your lender first. Some mortgage agreements treat unpaid property tax as a default trigger. For a paid-off home, the process is clean and simple. One application, annual renewal, tax bill goes away. 3 bonus moves. First, the disabled veteran exemption. It's in almost every state. A 100% service-connected disability rating in Texas, Florida, Virginia, Pennsylvania, and many other states means 0 property tax for life. Even a partial rating, 30%, 50%, 70%, often translates to a proportional exemption on top of every other exemption on this list. The form is usually 1 page, plus a copy of your VA disability letter. If you served, file this form. Second, the surviving spouse carryover. When a senior homeowner passes away, their exemptions don't automatically transfer to the surviving spouse. They have to be reapplied for, usually within a year of the death. If a survivor doesn't file, the property tax bill can jump overnight, sometimes by thousands of dollars, on the exact household that just lost half its income. The county will quietly let that happen and never say a word. The form is short. The deadline is real. Don't let the county pocket your spouse's exemption. Third, protest your assessment. Every property tax bill is built on top of the county's appraised value of your home, set by an assessor who has never been inside your house. They use neighborhood comps, square footage, and assumptions, and they're wrong all the time. Every county has a protest process, usually within 30 to 60 days of the appraisal notice. You file a 1-page protest. You bring 3 comparable sales from your immediate neighborhood that came in lower than your appraised value. You sit in front of an appraisal review board for 15 minutes, and in a significant percentage of cases, your appraised value comes down, sometimes by tens of thousands of dollars, which If you're over 65 and a homeowner, there are at least 5 forms sitting right within your reach right now. These forms can stop, reduce, or completely freeze your tax bill. 5 forms. But before we go any further, let's clear up one massive misconception. Because it's the reason most qualified people never file a single one of these. Some people say this is only for low-income retirees. Comfortable homeowners who've paid off their mortgage think, not my problem, and move on. Others go the opposite direction. This is for wealthy people. And seniors living on Social Security tune out entirely. Both are wrong. And honestly, both assumptions are costing people real money every single year. Let me be even more direct about this. The person who owns a modest $150,000 home and the person who owns a $600,000 paid-off home are both overpaying. Just in different ways. The lower-income homeowner is missing exemptions that could cut their bill by a third or more. The wealthier homeowner is missing freezes and deferrals that could save them tens of thousands over the next decade. The system doesn't discriminate when it comes to taking your money. And it doesn't discriminate about who it's willing to give it back to, if you know how to ask. Then there are the people thinking, my mortgage is paid off, taxes aren't really a big deal. They are. Absolutely they are. The property tax bill on a home you already own outright is the single biggest recurring expense you'll ever face on that property. Think about that for a second. You worked for 30 years to pay off that mortgage. You sacrificed vacations, new cars, and countless other things to own that home. Free and clear. And yet, every single year without fail, a bill arrives that treats you as if you owe rent on your own property. The county doesn't care that your loan is gone. The bill still comes, and it goes up almost every year. What if you're renting? Still relevant. The landlord pays that tax and passes every dollar straight to you through your rent. Every single month, when that bill drops, your rent stops climbing the way it has been. I want renters to really sit with that for a moment. Every time your landlord's property tax bill goes up, that increase eventually finds its way into your rent. It might not happen immediately. It might be disguised inside a general rent increase, but it gets there, which means anything that reduces the tax burden on rental properties is directly connected to the rent you pay. So this list is for everyone, whether your home is worth $90,000 in a small town or $400,000 after your county reassessed it last year. Whether you're living comfortably or watching every dollar carefully, there's real money on this list with your name on it. Why does nobody talk about these forms? Because the county tax assessor's office runs on the taxes it collects. This catches people at the worst possible moment. You've just lost your partner. You're managing grief, paperwork, legal processes, and financial adjustments all at once. The property tax exemption deadline is the last thing on your mind, and the county will absolutely let that deadline pass without saying a word. When it does, the property tax bill on that home can jump by thousands of dollars overnight on the exact household that just lost half its income. Don't let that happen. If you've lost a spouse in the last year, or if you're helping a parent navigate that transition, call the county assessor's office and ask specifically about surviving spouse carryover applications. Ask about the deadline. Ask which exemptions were active on the property. Ask what documentation is needed to transfer them. The form is short. The process is simple. The cost of missing it is not. Third, protest your assessment. This last one has nothing to do with the county giving you a discount. This one is you pushing back. Every property tax bill is built on top of the county's appraised value of your home, and that value was set by an assessor who has never stepped foot inside your house. They use neighborhood comparable sales, square footage data, and general assumptions about condition and features. They are working with incomplete information, and they get it wrong constantly. Your home might have a roof that needs replacing, a foundation issue, an outdated kitchen, an awkward floor plan that makes it less marketable than the house next door. The assessor doesn't know any of that. They looked at the square footage, found a few nearby sales, and assigned a number. That number is not final. It is a starting point that you have the legal right to challenge. Every county in this country has a formal protest process, typically within 30 to 60 days of the appraisal notice. You file a one-page protest form. You gather 3 to 5 comparable home sales from your immediate neighborhood that support a lower value than what the county assigned. In a significant percentage of cases, the appraised value comes down, sometimes by $10,000, sometimes by $50,000 or more. That reduction lowers your tax bill not just this year, but every year going forward until the next reassessment. And since most assessors reassess on a 2 or 3 year cycle, a successful protest this year protects you for multiple years. Fewer than 5% of homeowners ever protest their assessment, but among those who do, close to half receive a reduction. The seniors who get these exemptions are not luckier than you. They are not wealthier than you. They did not have better accountants or better lawyers or better connections. They just knew the form existed. That is the only difference, and now you know too. Go make the calls, file the forms, stop overpaying for a home you already own.